Hello YouTube, I'm Philip Sirius, this is my brother Andrew Sirius, and we're here to answer the question, if you want to get into real estate, what do you do if you don't have enough money?
Yeah, having money is nice, but it's also not something you necessarily start with, and so like getting into real estate can be a challenge if you don't start with it. Like, real estate is a way to make money, but it kind of takes some money to make money.
But the question is, how much money do you actually need to buy a house? That's kind of the first question.
It really depends. I mean, it depends on what you're going for. So I think the first point is to figure out what you're trying to achieve and also what you can achieve, and that depends a lot on your market and on your strategy. The most conservative and also difficult to achieve would be just buy for cash. Now, I mean, this is like, how do you buy real estate if you're sitting on a pile of money? I don't know if you need to watch a video for that, but we'll explain it in detail right here. You take the money and you buy the real estate with it. This would be like the Dave Ramsey on steroids model, you know, buying for cash. And
I mean, and a house could cost anywhere from $50,000, a good decent investment house, to $1 million if you're buying an apartment or something, you know.
Or in an expensive market.
Yeah.
And then most investor loans, not all, are 75% LTV, so 25% down. And in more expensive markets, it might go 80%. But if you're just going to buy a house or an apartment to rent out, it will usually be 25% down.
The best way to do that is to save, honestly.
Shocking.
I mean, have a job, make money, save it, be patient. Live beneath your means, and a lot of people invest in real estate that way. It's honestly a really good way to do it.
Probably even better way to do it is to basically like a zigzag. You start off as a homeowner and then move into an investor with the same property just over time.
I'm doing that currently right now. The house I bought 5 years ago, I've lived in, and it has been my personal residence. I bought it with the intention of, once I moved out of it, turning it into a rental.
This is, I think, the best way to think of this, because it's so much easier to buy as a homeowner than as a renter or as a investor. The financing you get from FHA is 3.5% down, 96.5% finance. Many banks offer 95% for people. Like we both, I think, got non-FHA bank loans at 95% for homeowners, and the interest rates are absurd. You do have to pay mortgage insurance. It's PMI, which sucks. It's on top of your mortgage, so it's more expensive. But the insurance, the rates you're getting as of the posting of this video for homeowners with decent credit and a decent job history is in the threes, and sometimes I've seen it in the twos. So that kind of makes up for that PMI sucker punch.
It's basically and effectively a higher interest rate is what it is. But I mean, if you have a stable job and you can get good credit and you know you can live a disciplined lifestyle, you can save up 3.5-5% for a house to live in and then move out of, and then you have a rental. You get your next house.
I think with a lot of people, patience is a virtue. If you and also the gurus who are always bashing having a job are really, I mean, they're fake. They're doing a disservice because they're lying, fake frauds. I mean, to be blunt, but it's like having a job is not something to be ashamed of. No. It's actually something to be.
It's a great way to invest in real estate. It really is.
The save and hold, or save and buy and hold, is a great method of buying real estate for most people. Not everyone.
Banks want to loan to? They want to loan to people who have stable W-2 income.
So
That's what they want to loan to.
If you're asking me, like, I have a job, I've had a job for 6 months, and the bank wants me to have a job for a year before they'll loan to me, probably the best way to buy a piece of real estate is to keep a job for 6 more months and save up money during the time. You can buy a property, 3 to 5% down, which is in many markets, particularly in the Midwest, South. I mean, not on the coast, is not that big of a down payment. Even $200,000 at 3% down is $6,000. 5% is only $10,000. I mean, that's something you can save over the course of a year, generally speaking. And I think there's 3 primary ways to go about this. The first one is just buy your own home, live there, continue to save.
Kind of what we talked about,
as a starter home, and then whenever you move out, do exactly what Philip's doing, and what I will eventually do when I move out as well. Keep your current place and as a rental, and buy a new one. And to do that, the key thing is banks are going to be hesitant about considering that new property's rental, your old property's rental income. So you should buy a property, like if you can afford here, buy here. Buy up front. That way. It might not be quite
buy that
as
starter home with the intention of doing this plan.
Maybe you want to live in the 4 2.5, and you can only afford like a 3 1.5 with like with a 1 car instead of a 2 car garage or something. But that take that small hit because you can keep that as a rental much more easy. One, those properties rent better, generally speaking. And two, it will be easier to get approved for the next one, which you should be thinking of, because real estate is long term. If you're thinking short term in real estate, you're in the wrong business.
Well, I have something to say about that later. But
you go speculate in cryptocurrencies or commodities or something like that. You're in the wrong business. This is a long term hold business, and so buy that one a step down so you can get the next one in a couple of years or whenever you do it and hold that as a rental. An even better way to do it is house hacking, where you buy a house that needs fixing, and this is especially if you're handy. This is kind of for people who are handy or know people who are handy and can do work for them, and just live in it while you fix it up. I have a friend who did that in Poughkeepsie, New York, I think 7 or 8 times, and he's got a strong little portfolio there. And pretty much all he does now is manage his properties and do the maintenance and rehab, and that's what he wanted. And it's like that. You live in. You're basically it's like a hybrid investment.
Yeah, it is.
Yeah, you are doing the rehab, in other words, having no holding costs because you're living there. Now, the property can't be a complete disaster, and it can't...
Unless you're a single guy willing to live in some less than ideal circumstances.
Yes, which there are examples. We have a friend investor who started in St. Joseph, a house that was like leaking all over the place and whatnot, and like whatever, if you're willing to do that, do it. But he wasn't house hacking, but if you're willing to live in a pigsty, go for it.
You can figure that one out.
Yeah, if you can fix it up, you can fix it up.
It's called sweat equity, is what it's called.
The sweat equity. You got to get that sweat equity.
Because you have no AC, so you're literally sweating.
And so, but that way you have no holding cost, and you're basically living in a property you're investing in. It's a hybrid. But I think the best way overall is FHA financing. You can get it. And this is, yes, you can only buy a homeowner-occupied property. You have to live there for at least a year. But it doesn't have to be a house. It could be a duplex. It could be a fourplex.
Yeah, exactly.
And if you can find a fourplex, get 96.5% financing, you're 310. First of all, you're already an investor. You live in one unit. You rent out the other 3. They pay probably most of your expenses. You probably have a little bit above that, and then after a year, you can move out. You can perhaps you can refinance if the market's appreciated. And get a new FHA loan, or you can only have one FHA loan at a time, or you can get a loan from a bank on your next property. But that is your foot in the door. You buy a duplex or a fourplex with an FHA loan, you are an investor right off the bat.
Yeah, and I mean that takes a little bit of savings and money, but I mean if
and job history. Yeah, it's okay to have a job. People, the gurus are lying.
So they're all the gurus and stuff, whatever, they love to talk about zero money real estate, no money real estate investing. You don't need money.
You don't need it. It's pointless. Except to buy their program. Yeah. You do need money. You need to negotiate with your credit cards to increase your limit so you can buy their 3-ring binders that will teach you how to buy real estate with no money down.
Mm-hmm. It's free real estate. Anyways, so I mean, usually a lot of times they're talking about wholesaling, which I'm just going to go on a quick tangent here. Wholesaling isn't really real estate investment. It's basically a job inside of real estate. It's basically sales and marketing inside of real estate.
The big criticism of wholesaling is that you're acting as a real estate agent without a license.
Yeah, it's not really investing in real estate.
we're not going to get into that debate now. I can go over both sides of that, but regardless, it is kind of true. You are basically doing what real estate agents do.
Yeah.
And there's nothing wrong with being a real estate agent, but it's not investing. You're
an unlicensed real estate agent. Yeah. Basically doing the job of a real estate agent. It's not really investing in real estate. It's having a job in the real estate market. It's a way to gain money and experience in real estate, which can be good in that sense, but it's not real estate investing. But there are ways to get properties with none of your own money. I guess there's kind of 3 main ways.
Yeah, there's 3. They're all kind of similar, and they all work. But they are, to say they're just no money down strategies that are just like that you can make a fortune on, even if you came into real estate without a penny in your pocket, are false. And the first one is just is subject to, which is buying a property subject to its existing financing, and you just take the loan that the current owner has, and you put it. Now you pick the payments. You can't put it in your name. That would call the loan due. The problem with this is there's always the property now is almost always going to be worth more than their loan is.
Yeah.
And so there's going to be a gap there, and you need to make up that gap. So it's not really.
Also, you have no money for repairs if repairs are needed.
That's kind of endemic throughout all of these
Yes.
examples. Yeah, so that one is really tough.
Well, if it's just like a rehab property, you don't have the money to rehab it to make it like a flip or a rental or anything like that, you know, if it's kind of a dumpy property.
A contract for deed, or in some states a land sales contract, is basically kind of a lease option, but you get an equitable interest in the property. So you basically get an equitable interest in the property, and you have the right to finalize that deal and complete the purchase at a certain date. You know, kind of like a lease with an option to buy, but you have an equitable interest in it. And it's the same thing. You can get into it immediately, but you have no money for repairs. And then also there's seller financing. Now this conceivably could provide money for repairs, but they would have to lend you over and above what you buy it for, assuming, or you have to buy a property.
They have to come to closing with money, which doesn't make, usually the reason for seller financing is not that. So,
or you have to buy a property that needs no work, and
then you still don't have any money for if you know the HVAC goes out or the roof needs repairs.
And that's the thing. Like one, if you have no money, there are capital expenses that would come with that. First of all, just on those three, like, there aren't that many people willing to, if they have no work on their property, why would they do any of these? You can just list it and sell it. Now there are some people who will do kind of odd things, but then those strategies can still come into play. I'm not saying they're gone, but they are low money down strategies, not no money down strategies. And you have no money for repairs, and you have no money for the capital improvements, just like you're saying.
Yeah.
If your HVAC goes out, you have or your roof goes out.
You got to evict your tenant. Your tenant doesn't pay. You know, you're in a lot of trouble all of a sudden.
Long term, remember, whole real estate. As we've discussed in another video, you know, the advantages of real estate are many, but cash flow is the smallest of it, and it can oscillate. You know, you have a big expense per month, you all of a sudden have. You can't afford it if you have no money. So you need a reserve of some sort, at least probably $5,000 to $10,000.
Also, these aren't really scalable ways to buy. They're rare opportunities. You got to put a lot of work into finding them, or a lot of money into marketing to find them.
They're tools in your tool belt. They shouldn't be your.
It's going to be hard to build a large portfolio out of these kind of things. If you're patient, you have a lot of. You know, you have a lot of time to work on this. You can find them here and there.
This deal makes for seller financing. This one would make sense for a land sales contract. This regular purchase is like, that's kind of how to see these. They're tools to be used as you go. I think the main one to use, if you are to buy for really low or no money down, are private lending and partnerships. Yeah. And like the partnership model would be simply you find somebody who's got money but doesn't have the time. You bring the time. They bring the money. Or a private lender. They loan you the money. I mean, basically the way to think about it is you can have a job to make a lot of money to put the down payment or buy the house. You can have a little bit of money to do these unique strategies, or you can use someone else's money and partner with them, or have them loan you the money to buy the house. And those are things we've used a lot in terms of buying a property. A lot of the properties we bought haven't been money we've built up over time. We borrow money from other individuals to put in the house. The whole BRRRR strategy that we talk about a lot is buy, rehab, refinance. Buy, rehab, rent, refinance, repeat.
We start that process with a private loan on the property is how we do that.
Now finding these people can be relatively difficult, but it can snowball on itself. Once you have a track record, it becomes much easier. So perhaps if you can't find a private lender now, it's not the end of the world. Perhaps keep looking, but also start with one of those other strategies. Buy that FHA property, house hack, get some deals under your belt, and then all of a sudden you can move towards that place where people are like, oh, this guy does have experience. He has a proven track record. He's done several deals, and that makes this person is much more likely to follow through. Lending to them makes much more sense. But if you want to learn how to find those private lenders, first of all, subscribe to the channel. But the video you need to check out is this one on private lending that we did. Check that one out now, and we'll see you on the other side.